welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management, coming to you live from Palm Desert, California. This is July 14th of 2021. Thank you for joining Blanke Schein Wealth Management's Mid-Year Outlook. We have several guests that are going to be joining us. We're going to take just a few moments to pause, allow everyone to log on. We're excited to announce that we have a lot of clients around the world that will be listening and tuning in. We have, as far as Croatia, tuning in, so it's evening time there. We also have clients in Alaska, in Florida, in Maine, and all the way to Hawaii, everywhere in between. Again, that's the power of not only technology, but who we serve within Blanke Schein Wealth Management. All right, let's get into it. And let me first start by sharing my screen. All right. So again, it's our 2021 mid-year outlook. Our consensus, our thoughts here at Blanke Schein Wealth Management. Keep in mind that we are independent and we're accredited investment fiduciaries. And what that means is we are completely have the access to independence as well as all of Wall Street thinking, plus 50 plus independent research firms that we curate our information as well as in our thinking with our investment committee here to give you our best thinking, our best ideas, sort of a mid-year outlook. We do two times a year at least, and this is that. And we're looking forward to hopefully the next one is in person, and hopefully everyone's staying healthy and safe as we are here. So our first slide of the day, just like technology has changed our lives, as well as more connectivity is our promise and our mission here at Blanke Schein Wealth Management to our clients. So mid-March of 2020, we realized obviously the world's changed. We couldn't have in-person meetings, but we also knew that the headlines of the day at that time, right at the very beginning of what turned out to be a global pandemic, were extremely negative, end of the world negative, almost too much so as it relates to what we do here for our clients in the investment management world. So we basically huddled up and said, well, how can we get our narrative, our thoughts directly to our clients on a daily basis? And we started a YouTube channel. And I'm happy to report, one, if you're not a subscriber, we encourage you to like and subscribe to our YouTube channel. Also, if you're a client of Blanke Schein Wealth Management, you can also get our emails. We send them out Tuesdays and Thursdays, as well as a Friday Insights. I do special interviews from time to time with portfolio managers or subject matter experts, call it estate planning or CPAs and estate tax law changes. And you look forward to those special interviews, as well as Rick Blanke Jr. does financial foundations, and that's a phenomenal series as well. Again, we have total subscribers, just about 1,800 subscribers on our YouTube channel. I've produced over 250 videos since March of 2020. So we've been busy, as well as lifetime views, over 61,000 hours of viewership. And what's important is that we're putting our thoughts, real-time relevant, market-related information on video. So this is what we're thinking. And we've been more than right on many of the occasions. So we're happy to continue to produce sort of our best thinking. This just shows a HighTower footprint, our partnership nationally. Those numbers are outdated from last year, and we've grown significantly since then. Not only our practice here at Blanke Schein Wealth Management with our clients grown best year ever last year, and this year we're on pace to even eclipse that midway through the year. So thank you to all friends and family for referrals. And our commitment, again, as accredited investment fiduciaries, we put our clients in the center of everything we do. And we have nothing to sell. We don't have any products. We just have the fiduciary standard of our advice and our commitment to you and your family. Again, I'm not going to spend too much time because most of on our call today are clients. Here's our disclaimers. It makes everyone happy. And then again, all of our access that we have, our research, as well as our investment research, and all of the partners that we have on a daily basis to gather our information. Again, our process is financial planning driven. So if you haven't updated your financial plan or your life circumstances have changed recently, we encourage you to reach out to any one of whether Rick Jr., myself, or anyone on our team and say, hey, listen, let's take a look at my financial plan. Let's look at what if scenarios want to sell a house, buy a house. That's very popular these days with the hot real estate market. Let's put that in our financial plan and then see what the result was or what it could be as we project that on your 360 True Retirement dashboard. Again, that could be updated on demand for you. And then our experience, what sets us apart, again, as you know, as a client, these are the sort of core features of our service model to provide what we do for you and your family. Obviously, the financial plan, the True Retirement 360 I just highlighted, but we also anchor that with education, right? We want everyone, our clients, to know what they own, why they own it, what it's supposed to do for you, and ultimately be confident in your financial life. We provide the guidance, our wisdom and experience. We believe you can't get that on the internet. That's why we're here to guide you through every step of the way. And everyone's going through something financially speaking. So please reach out to us. We're happy to help you. And then obviously our Blanke Schein Wealth Management investment process. That's where the team comes together. Every Tuesday morning, we have an investment committee meeting, and we basically have our high conviction list that we update. And then that really works its way into our client portfolios when opportunities present themselves. And finally, we second to none. What's different from all of us, all of our competitors out there, is our service. Our team, from Sherry to Leslie to both Rick and myself, and now we have Corbin and new other team members we're going to excited to announce as we're growing. We're here to serve you. That's our main job. So that's the difference. We're one phone call away, and we are here for you. So let's get right into it. Our today's topic, which is our market outlook and overview. I have 10 bullet points that I'm going to go through in a short period of time, and hopefully we can get some questions. If not, we can follow up with those questions and provide an FAQ, frequently asked questions, post this webinar. Number one, I'm going to go through today's new bull market. And go through that concept of showing you sort of the empirical evidence that we've created from March of 2020 of a new bull market, which is important to take note of. As well as number two, we're going to talk about the 10-year treasury. If you've been watching my daily updates or biweekly updates, I have talked a lot. In fact, the show has been year to date, the 10-year treasury from, starting off, in the mid 1.5 to 1.7 to 1.25 last week. It's been exciting, and the equity markets have been the sideshow from the main event, which is the 10-year treasury. Obviously, commodities, we'll talk about that. And we'll go through the U.S. and global economy, check in there. The fiscal and monetary policy, it's equally important. Earnings, it's all about earnings. It's about the recovery, and the rate of change will change. We'll discuss what that means. Is inflation a real story? Again, that's another coupling with sort of the 10-year treasury story or the global economic recovery story. And the Fed, are they prepared for a gradual rise in rates? Or are we prepared, better yet, right? So the Federal Reserve is going to be having to raise rates at some point in time, but it could be long off in the future. And we'll discuss that today. And will housing market remain hot? That's a good question. Number 9, the volatility. We believe here at Blanke Schein Wealth Management that volatility equals opportunity. We're going to talk about how we take advantage of that for our clients later on. And number 10, in today's present market where the banks are paying you 0.25% or less than on your bank deposits, cash is really like quicksand, because what the Federal Reserve is doing is they're inventing inflation. They're creating inflation. They're going to let inflation run hot. That's their own words. So at their 2% inflation target, and if you have a 2% inflation target, or inflation is all around us, and you have the bank paying your cash only 25 basis points, that net spread is negative to you. So you, in fact, in 1 year's period of time, it's like quicksand. So we'll talk about opportunities to put your money to work and have your money work as hard as you do. Let's get right into the new bull market. So like I said before, this is a slide that we use from all of our research partners. Cornerstone Macro is basically saying that 2020 was largely a year of market recovery, while 2021 is a year of economic recovery. And by this chart, you have sort of a look, an analytical look of historically a 30% or greater decline in the S&P 500 index has led to stronger forward returns. Obviously, it's not a straight line, right, by percentage standpoint. But if you look at all the sample sets of history, so we're looking at the 87 to 92, 09 to 2014, 74 to 79. These are all different marketplaces of the past performance, and 1970, 68 and 1987. And if you look at this, we have a drawdown. So right here is what's called the drawdown, how much the S&P went down in the calendar years that I talked about. So the peak to trough, 87, 2000, 73, 68, and 87. And we saw that the market, right, if you recall last year, from February to March, was down by 33, almost 34%, because the unknown of the global pandemic. Now over here, right here, this is the green that's starting what we're calling the new bull market. And it's only to right here on this. So from starting of the 23rd of March to present day, so this is at the end of the second quarter of this year, the market went down in the period of time, the drawdown, by 33%, but it's been up roughly 74%. And that's this line right here. That's where we are for today's current market. Now, what's significant about this is that when the markets go down by 20% or more, it resets to a new bull market. And that's important because if you recall, right before that, we had a strong economy. Unemployment was at the all-time low, going back to the 1950s. Everything was going, the Trump tax cuts were in full gear. Corporations, business confidence, unemployment on all economic scales were at the best levels that we've seen. Housing was just starting to pick up. And they were wondering when we would have a reset, when we would actually have the economy pull back or the stock market correct by 20%. Well, we hit February, and then obviously the global pandemic hit, and we did have that 20% more than reset. Now let's look at what's significant about this is 1 year later, 3 years later, and 5 years later, when we have a reset like that, historically speaking, what's happened? Well, this is where we are right here. But going back to 2007, 2009, the Great Recession, if you will, most recent, that first year recovery was a 68% in the S&P 500, but a 3-year number is 102%, and a 5-year number is 177% increase on that percentage increase on the S&P 500. It's really significant if you look at all the rest, 1 year recoveries, the 3-year recoveries, as well as the 5-year recoveries are all positive numbers. Now, we can't predict or project what's going to happen on the S&P on a forward-looking basis, right? But we use history as a guide to say, hey, listen, our averages are about a 46% recovery in the index for the first year. 17% average 3-year annualized rate of return, and about a 14%, a little bit higher than that, annualized rate of return for a 5-year. So these are significant numbers in terms of we annualize the averages. Again, we don't know how this is going to play out here, but that's why we're long-term bulls. And this is starting a new bull market, historically speaking. So our investment committee. So Blanke Schein Wealth Management, as I said, we have our investment committee from Don Stockhausen to Rick Blanke Sr. and Mike Shields and Rick Blanke Jr., and myself and Corbin Lifko, and a few others. We also have the addition this year of Stephanie Link, who is a strategic partner. Not only does she manage portfolios directly for our clients at Blanke Schein Wealth Management, and also you'll see Stephanie probably twice a week on Fast Money or any CNBC show. She's a frequent contributor there. So we're happy to have Stephanie Link as well as a strategic partner. But her guidance is imperative as we drive our best thinking and our best thoughts for high conviction strategies here. Really, we look at the 4 horsemen, the fundamentals of the economy. We look at the technical analysis, sort of moving averages from all the 20-day, 50-day, 200-day on the indices. That's important as well. The sentiment, is it negative? Is it positive out there? As well as policy, both fiscal and monetary policy. And I will tell you, we're both in a good spot with 2 of the 4, and 2 of them aren't that bad at all. So right now, without getting too granular on this, we're in a good spot with the 4 horsemen. Nothing shows any signs of concern right now. Now, let's go to the 10-year treasury. As I said before, it's been sort of the front and center stage this year. And so have commodities, right? We saw the spike in lumber prices gone up, and now down by 50% since the start of the year, up and down by 50. And all the other commodities, you're seeing it, I'm seeing it at the grocery store as well as in everything. There's huge inflationary pressures that are putting pressure on the market as well as supply chain. And we'll see if that will be passed on to the consumer. We're seeing it on the kitchen table here at the Schein household, because the cereal and the ice cream boxes are getting smaller, but they're charging the same prices. So that's also a form of inflation. But what's happening right now, the commodities are showing sort of some signs of leveling off or maybe even weakness. Commodities consist of all of the things I talked about, from anywhere from soybeans to lumber to even gold, precious metals, and a few others. Okay, highly volatile, but we've seen since the start of sort of the pandemic have taken straight off from the bottoms of the April 20 lows. Now, along with it, we saw treasury yields, the 10-year treasury. But if we start at the very beginning of this year, treasury yields ran up, and now they hit the 172 level, and now they're tapering down. And what that means is that we could find a trading range for the 10-year treasury. It's being artificially anchored by what the Federal Reserve is doing. They're they're keeping the short end of the yield curve, or i.e. interest rates, down. Lower for longer is their sort of mandate, is because they have two mandates. They have full employment as well as inflation. So they've already said, as recent as this morning, Federal Powell has said this morning, that they're going to let inflation run hot, as they focus first and foremost is that the employment picture improves. But we'll see how this plays out. We're seeing sort of both commodities and 10-year treasuries telling us a story we have to pay attention to. What ultimately drives markets and keeps sort of equity markets, as we've seen this year, all-time highs in the Dow, the NASDAQ, and the S&P 500, is the U.S. earnings picture. U.S. earnings growth estimates are exceeding the peak of early 2020s, which is pretty significant. Both these green line here is the S&P 500. And right now we're looking at some analysts, or even First Trust economist Brian Westbury, is looking at a 4,500 for the S&P by year end. And we're very close to that right now. So we could see some room to run, but not very much, because markets have run up really quickly. And the blue line underneath the green line is the forecast, the 12-month forecast of earnings per share for the S&P exceeding $200, which is now going back to being higher earnings than where we were pre-pandemic for all of the S&P, which is significant. So we hit a pullback and recovered, and we've exceeded those that were pre-pandemic, which was when the economy was all-time high not too long ago, which is incredible. This is a sector breakdown showing different sectors are going to have higher earnings growth than others. It's understandable. As an example, earnings growth is non-existent for some of the energy companies, at least predicted and projected for 2021, but 2022, we're going to see a significant growth in earnings year over year. And all of this down the row here is just going to provide opportunity as we manage portfolios at Blanke Schein Wealth Management, because within the 11 sectors of the S&P, we will find some valuation opportunities. This is a global economy snapshot. And what we're looking at here is a composite of the Purchasing Managers Index. It's the PMI. And it really indicates if economies are accelerating and heating up, are they moderating, or are they slowing down? And the real number is really to see if an economy is expanding. Is 50 or higher is that number. And what you're seeing is globally in the top line, if you just take your eyes and go from January 20th on the left-hand side all the way to the right to May of 2021, where we are, we saw the color pattern here also lends your eye to it. We saw some weakness with the left and the right-hand side with the pandemic. But as we go left to right, you're seeing across the board, both global markets, developed markets, emerging markets, the US, UK, Japan, Euro area, as well as China. Every single one of them are getting close to above 50. Some of them are in the 60s. US, we're in the 68 category. It's a super hot print, heavy. That means the economy is super heating up. And it's a positive sign. And it also indicates that the demand is there. So that's one element to say, hey, is the recovery real? Yes. Another one we look at, again, is the PMI on a chart. And it's just showing all the different countries around the world, from Germany, UK, China, Italy, France, Spain, and Japan. Now, keep in mind, there's the Delta variant that's out there and hitting each country, each region geographically different. And every country sort of working their way through the pandemic. Historically, we do see that the US leads the global markets by 6 months. We're also seeing that on this virus, which is ironic as well. The take-home point here is that the trend is our friend. This V is very real. And even though we could have a slowdown in the sort of recovery simply because of supply chains, factories closing around the world, that could still cause a transitory inflation. This recovery can't be discounted in terms of it's not real, because it is real. There is a reopening story. The global economy is also following suit with the US economy. So that's a positive thing for economic backdrop in the US as well as globally. Now, what's the continue to pull forward sort of fiscal stimulus would be the Biden administration, sort of another round of stimulus, as well as the right now is called the infrastructure bill that we're seeing right now being debated in Congress. And what's interesting to see is that we've got a fiscal cliff from a policy stimulus sort of falling off the cliff, if you will, setting up here. So more fiscal stimulus in 2021 leads to a 1.8 trillion fiscal cliff in 2022. So as we've seen in the last couple of years, both fiscal and monetary policy very supportive. We're also seeing another round why Congress is looking towards adding more fuel to the fire of an already strong economy. Again, they're doing what they do best, which is debate. How this plays out, we're not going to venture to guess, but we will stay tuned to follow all the different variations that Congress will come back with a fiscal package and how that money will be spent. That's the most critical take-home point, which is where that money, our tax dollars, hard at work, do they actually make it to infrastructure spending or other areas of the economy? That's really going to have the impact here, long-term effect or not. Now, as I said before, Congress and taxes go hand in hand. And what's to expect? Well, the administration's campaign on increasing the taxes, they're not going to fall off of that. I think they're going to get it on higher income earners. The question is, how low do they go in infringing upon sort of other tiers or middle class, if you will? Many proposals will be forward, including taxation and capital gains will pull forward. As of right now, I think one of the things that market was actually rallying on was the fact that Congress didn't get the moderate Democrats, so Joe Manchin from West Virginia, on board, because they do have the majority. They have all three houses, and they could pass anything they needed to. But the moderate conservative Democrats are sort of holding the line, not the Republicans, if you will, in this case. The moderate conservative Democrats are holding the line, fiscally conservative, if you will, and sort of they're slowing down the process, and that's a good thing, because the more that Congress doesn't have the ability to tax and spend so quickly, the better markets do in the long term. And so we're seeing sort of that reprieve where we thought back in March they're going to get something done, and they're still in the middle of the summer, so working away. Now, we believe they will get something done, and it's likely to pass in 2021. We also don't believe it's going to be retroactive this year. That'll be pretty hard to do, which means it'll be enacted in 2022, but it'll set us up for sort of what we saw in 2022. It's another sort of mid-cycle election year. Again, the majorities are razor thin. So we could see another political 94, right? 92 was Bill Clinton. 94 was Newt Gingrich, and the Republicans took back sort of a super majority back then. And then that's what you had, all the fiscal stimulus, all the spending in the early 90s. You had Reaganomics taxes, even on that foundational backdrop where Clinton came in and sort of changed some tax reforms and did a lot of spending. And then you had Congress stop. And they didn't do anything for the next 6 years, if you will. And that really then led to the equity markets taking off. If you go from 94 to 99, that's when we had the best bull market we've ever seen in the history of the US economy. Now, are we setting up for like that? We don't know, but the 2022 election could have a significant impact on what's done is done, higher taxes, but then holding the line on a go-forward basis could be very imperative as to future returns and increasing in earnings. Now, what's important about this is working with us here at Blanke Schein Wealth Management. We're going to stay ahead of this for you. We're going to stay on the sort of breaking and developing ins and outs of all the new tax policies, but more importantly, what strategies can we employ, not only from the investment management standpoint, tax-wise, tax-smart investment strategies, but also from sort of estate planning and taxation. You know, sometimes there's always a give and a get, and there's some incentives that we could stay ahead of and provide that advice to our clients. Now let's go to earnings. What this slide really shows is that there's a significant growth in earnings year over year. Now, if we look at the second column here, and let me try to get my drawing back here. The second column here, right now, this is showing the second quarter of 2021 in this blue, a 61 to 65. Right now, the most recent is revised up in terms of Wall Street's estimate. Again, we're kicking off earnings seasons right now. The banks have reported. And so what we're going to pay attention to is how all of the corporations report, but there's a 60 to 65% increase projected on earnings per share growth quarter over quarter, year over year. That's significant. As I said before, we're now exceeding what we had on all-time highs in earnings growth and earnings drive markets. Now, obviously, as we get back half of the year, we still have a 23% and a 17% projected earnings growth as an estimate for the balance of third and fourth quarter, respectively. That being said, it's tremendous. That's earnings growth we haven't really seen in quite some time. Again, another reason why equity markets are moving ahead. And let me go to drop this down. This is another, just talking about earnings growth. Right now, the projected 2022 for the S&P 500 quarterly earnings per share growth, year over year change in the first quarter of next calendar quarter, so 2022, is only a 2.7% growth rate, but then the following quarters is a 14, 14, and 14. It's almost too consistent. That's going to change. But what it's showing is double-digit earnings growth for even next year is anticipated. And why is that, Rob? How could corporations grow as much in a pandemic world? A couple of things I've talked about in my daily videos. One, technology is bringing in just a whole pulling forward of efficiencies in businesses. We're using it at Blanke Schein Wealth Management, not only here for technology, which also is really scalability, but every corporation is doing that. Again, another thing what corporations are doing is the amount of retirees. We've seen an influx of our clients who are on the cusp of retiring say, you know what, COVID's over. I kind of really don't want to do now is a good time for me to retire. And so we're seeing a lot of rollovers consistent, where corporations are offering early retirement packages for the 60 to 70-year-olds in that workspace. Now, those are the highest income wage earners. So if you have a wave of retirement coming out of the workforce on those corporate balance sheets, they're saving, right? 30% of just about anybody's a business is labor costs. And if you take the highest income earners off of that, you increase technology, you do less with more employees, or more with less employees, your margins, your earnings are pulled forward. And that's another variation here that's really not being talked about on today's business channels, but it's really being seen in the numbers. And that's why we see consistent earnings growth year over year, even more so as it's been accelerated. Now, the Federal Reserve is going to be interesting here on a go-forward basis. They've sort of been the headline of year to date, and it's almost like the Eagles Hotel California. We got this from Strategis, who's another partner of independent research. It's just spot on. And they came up with this sort of the theme that we're going to see play out on a go-forward basis, which is you can check in anytime you wish, but you can never leave. And that's really the modern monetary theory, right? Policy that we're going through, which is rising interest rates. We're keeping them right where they are, and full employment. And so in the stimulus, ultimately, what this is talking about has been provided, both fiscal and monetary policy, to support the foundational belief of the economy needs it. Corporations need it. The unemployment number is up. Now, keep in mind, full employment is key. That's the number one driver. They're going to let interest rates run hot, and full employment is most important. But if we go back on my board here, let's just do a walk back through history and keep this in mind, that unemployment back in the last two great recessions and the pullback, the tech wreck of 2001, 2002, and 2008, 2009, both those times for unemployment to get back to post those recessions, get back to pre-recession highs on unemployment, meaning everyone getting back to employing, fully employed, so on and so forth. Well, from the most recent, from 2008, 2009, it took 5 years for full employment to get back to the global recession there, if you will. And in 2001 to 2002, it took longer than 5 years. So while we appreciate the Federal Reserve's sort of focus on full employment, corporations, as I said, going back to this slide, are going to hold on to that earnings power and margin as much as they can with not hiring. So what's going to play out is rising of interest rates. It's going to be interesting. Now, the Fed's balance sheet, as you know, we've been following along. We've been talking about this, is that it's now going to be close to from 7 trillion to 10 trillion by year end. And what this slide is showing on the right-hand side ultimately is, what I want you to take note is mortgage-backed securities. So the Federal Reserve's also buying in by $120 billion sort of on an ongoing basis. And inside that, mortgage-backed securities are part of that by they're keeping the balance sheet. So they're expanding their balance sheet and they're keeping interest rates artificially low. What that means is, well, here's what it really sets up to. This morning, I was up early watching the Federal Reserve Chairman Jerome Powell's prepared testimony to the semi-annual report to Congress. And he basically said, quote unquote, we're still long way off from where we need to be, where the Fed sees. And the Fed continues the discussion and asset purchases coming with upcoming meetings. So here's what's interesting, what they said this morning. We will provide an advance notice of any changes to asset purchases. As that previous slide I talked about, we had all types of asset purchases, from mortgage-backed securities, which helps the real estate market and keeps interest rates low, as well as treasuries. But that's going to be the key right there. Inflation has increased notably, and inflation is likely to remain elevated in the coming months before moderating. So he still believes that inflation is transitory, so it'll moderate. Interestingly enough, who was the counterpoint to this later on in the Business Channel this morning was former Treasury Secretary Steve Mnuchin, who basically said he's a very big fan of Fed Chairman Jerome Powell, very highly regarded, very intelligent, a lot of respect, but he respectfully disagrees that the Fed should be more concerned about inflation. I disagree with Chair Fed, there's a typo there, Powell's lack of concern. So what to watch and what to listen for, importantly, it's not so much what they say, but what they don't say on the coming months and sort of year end on a go-forward basis. Mortgage-backed security purchases are taping off. That's what I would put on the top right there, because it's really going to impact real estate and the pricing out. If interest rates rise, right, they're going to price out the new home buyers. If interest rates rise, that affordability index is going to impact sort of a big portion of that supply and demand side. The demand is going to sort of shrink and the supply could increase. That could stabilize some prices, which could be needed in the real estate market, but it will have an effect on the real estate market. So that's going to be key, as well as interest rates. And then the 10-year treasury, if it goes above the 1.72 as it did earlier this year, tests that level and breaks through, that's when we know that the 10-year treasury and inflation and the market and the bond market is going to send a message to the Fed that they need to start getting ahead of it and start needing to think about raising interest rates, which the Fed has said they're not even thinking about it until next year. Again, what's important to watch is credit. Any restrictions on credit or deterioration in quality, and if high yields start diverting from treasuries, what that means is if high yields start blowing out or start getting higher, if you will, right now they're super tight, they're super close to treasury yields. That means that you're really not picking up that much more of an advantage or incentive to go over the safest rate of return as noted in treasuries. So right now, when spreads are tight, it's a high quality environment. That means that the economy is stable. There's no concern. But if any of that on the bottom line there changes in the fixed income market, that's going to really impact the equity markets. That's where we're going to pay attention to it. But right now, it seems to be in line and actually in a positive direction. So Milton Friedman famously said, inflation isn't always everywhere in monetary phenomenon, isn't always everywhere in monetary phenomena. But really, at the end of the day, the definition of inflation is too many dollars chasing too few goods of services. And that's what we're seeing play out right now. And obviously, we're seeing it in the noise in the data, which is transitory, as what the Federal Reserve believes. But money supply growth is really the thing that really could be here to stay. Now, what I also want to draw our attention to for all of our clients here at Blanke Schein Wealth Management is the volatility equals opportunity. We have many clients. We have a lot of clients 40 years plus with Rick Sr. We have clients 30 years and 20 years, 20 plus years with me. And now, even a decade with Rick Jr. So we've had many years of markets driving or navigating through all the ups and downs of all the markets and cycles. And one thing that we want our clients to continue, and if you've been with us for many years, you know this, that volatility, to continue to think about as we take advantage of this for you, is volatility equals opportunity. Like as an example, last March in 2020, we held a strategic position of cash. And when the markets pulled back by 33%, we positioned and rebalanced strategically, proactively for our clients across the board. What that meant was we like to use cash as an asset class and then jump on opportunities when the volatility provides that opportunity. And our clients really know from firsthand experience how we do that. And that really is also attributing to our total return on a go-forward basis to stay ahead of inflation, to keep your income where it needs to be, and to keep you and your family sort of where you need to be financially speaking, to have the advantages and be able to do the things you want to do. And more importantly, even travel again, right? It's going to be exciting for later this year and early next year as well. But this is a chart of S&P 500 daily volatility, and it's showing the number of days where the S&P has moved a 1% up or down in terms of volatility, greater than 1% move. This goes back to 2009 to 2021 in the first half of this year. And what you saw is last year, obviously, we had a lot of volatility, and you had many days where, well over 100 days, where we had more than a 1% move plus or minus on the daily movement of the S&P 500. Now, the average right there is in the orange, and it's 63 days plus or minus. That's an average of the sample set, if you will. But what you notice is on the right-hand side is that we are well below the average, okay, even for the average over the last 10 years or so. So what we would say is don't get complacent. Anticipate that it really can't stay that anchored on a go-forward basis to abnormally lower volatility. We believe that we're going to see volatility on a go-forward basis. So we anticipate maybe the 25, 30 days that we've already had increase between now and year end. And again, that volatility, a 1% move up or down in the markets, are going to provide opportunity for us as we strategically rebalance for our clients. Again, this is another look at intraday calendar year declines and the calendar year returns. And what you're noticing is volatility is not a recent phenomenon. Each year, one can expect the market to experience a significant correction, right? We usually get 5% corrections and maybe a 10% every single calendar year. If you've sat with me recently, or if you've known in our reviews, I bring that up all the time for clients in managing level setting expectations. And it's important because, again, the markets do go down. But when they go down, it's if we just set it and forget it, that's where you kind of get sort of a mediocre ho-hum rate of return. If our clients are looking for a little bit better than that, so we take advantage of when markets are down and then put them into a better opportunity on a go-forward basis. Now, rising rates. Now, the question is, I brought up earlier, we know that the Federal Reserve at some point in time will have to raise interest rates. We know it'll have some ripple effects in all markets. Think about this like real estate, as I said before. And we also will have what's the knock-on effect on the S&P 500. Can corporations make money on a go-forward basis? Now, there's some sectors of the economy and some styles that will do better, growth and value or growth, depending upon if interest rates rise. Usually value does better. Or some of the S&P 500 sectors, right? There's 11 of them, as I showed earnings growth on a go-forward basis. Not all of them grow at the same time. Some of them do better cyclically than others. That's why we have the opportunity to take advantage of all of that. But on a majority, on the S&P 500, if we look at the last 9 sample sets through the last 60 years in the markets, when interest rates have risen by 150 basis points, that's what this sample set is from Strategist. They looked at the annualized performance during those period of times when the Federal Reserve rose interest rates by 150 basis points. And what you see is on all 9 of these historical sort of viewpoints, we have had positive rate of return. Some of them are double digits. Most of them are close to double digits, if you will. So it just shows that corporations continue to earn out sort of profitability on the top and both bottom line margin growth, but it also shows that S&P or the market at large, if you will, if we use it as a proxy, corporations can grow their earnings. That translates into higher equity valuations or stock market on a go-forward basis. So don't be so worried about rising interest rates. Is actually kind of a good thing because we don't have rising interest rates at some point in time. That means that the Federal Reserve is caught in the Hotel California range where they can never check out. The market's going to be anchored towards low interest rates, expect low interest rates. And if they try to raise interest rates, and that's going to be the story, will they pull a tantrum like they did in 2013? We will see. Here's my last slide, and then we can sort of wrap it up here because we have about 43 minutes and you joining us today of our thoughts. Is that cash right now and savings? A lot of our clients year to date have brought us bank earning or their bank deposits, right? So much so as you haven't really traveled last year or you haven't spent the money you thought of. And now you see that bank balance increasing. And so what we encourage everyone to do is jump on a call with us on an individual basis, and we'll do a review and say, hey, listen, or call Sherry or Leslie and send us in some cash that we can put to work, even in a money market equivalent, to get you higher rate of return than what the bank is paying you right now. Why that's important is because what I said in this basically broadcast right now is that the Fed is engineering they're all fully supporting inflation. Their target is 2%. They're going to let it go higher than 2%. Again, we know that everything we're spending money on, both here at home as you in your world, let's call it, education for me and medical, even travel is now seeing double-digit inflation rates. All of those, I don't think are transitory, right? I don't think that that's going to, I'm not buying a new TV every year from Costco that goes down and as soon as I buy it, because it's a 5 or 10 year item that is factored in the government's inflation rate, even core inflation rate. And that's not really, you have to strip some of that out. You have to say, what's your consumer price index to you? What's your CPIU, as I say, with a review of our clients? And again, what I spend money on is education, travel, or education, medical, if our world, if you will, and just groceries, if you will. And that's all double-digit rate of return. And a lot of our clients are doing travel. If you look at the travel sites lately, that's double-digit inflation growth as well. So how do we stay ahead of this? How do we position ourselves so that our dollar isn't quicksand? Again, you just call us and we'll help find sort of either a strategic alternative for what your bank cash is, or more importantly, we then can keep it in the portfolio. And then when the markets pull back, as they will, as they always do, we jump on high quality, high conviction thought, sort of our best ideas, if you will, for you. And within a short period of time, everyone's happy. You're making some money, and we're making certain that your money's working as hard as you do. Which is very important. So that's sort of the recap today of what our thoughts are. Again, we expect volatility ahead. We believe that the Federal Reserve is sort of the story to watch, what they say and what they don't say. But we also say that right now, again, we're seeing tremendous growth opportunities. On a go-forward basis, it's not going to be all boats, all water rises, all boats, because the tide's going to come back out, and then the higher quality names are going to continue to persist. So you don't want to own the indices, the index. You want to own individual names on a go-forward basis, because those will outperform the index. So it's basically active money management. That's what we do here at Blanke Schein Wealth Management for our clients, versus passive, the set it and forget it. This is the cycle that we are. But we are in a new bull market, we believe. We believe we'll see higher markets between now and year end, but we're going to see some higher volatility between now and then. We're just here to take advantage of it. If you want a review or a mid-year outlook yourself, or invite a friend or family member for us to reach out to share our thoughts, we're happy to do so. Again, thank you for everyone who's been wonderful and supporting us and tuning into our broadcast. We really appreciate that, because that really helps us sort of make certain that we're staying connected to you. I went through a lot today. If there's some topics that you want to drive down or have a further, deeper conversation with anyone on our team, we're happy. Please reach out. But we thank you. And thank you for tuning in all around the world. For those, our friends in Croatia tonight, I trust you're having wine right now. But you guys have a good night. And for those here in the States, enjoy your day. Be healthy, be safe. We'll talk to you guys next time. Take care.